what about the government? They don't seem to be having a whole lot of common sense when it comes to the shutdown and what's happening and, jobs reports and all of that. So what's going on now?
There's a showdown. It's mainly over healthcare, a
Yeah.
healthcare tax credit, essentially. There's some other things, of course, that they're trying to debate about, but we get in this situation all the time. Like it seems like all of a sudden we've run out of funding. We're running out of funding. There's a deadline. There's some issue that one side is trying to, make their issue, and they're not budging on this
Yeah.
until the other side does.
Right.
And at some point, we got to do something. And some solutions have been proposed, but then giving in is going back. And the whole point is that we're shut down
Right.
for a period of time. Longest shutdown I think was 35 days. I've lost count how many days we are in now.
Yeah, I don't know.
But I do know the effect that it's having, and this is not a great time for a shutdown because there's no jobs reports coming out. Whether they were accurate or not, like we need them, right? Because we're trying to, the Federal Reserve is trying to decide: are we going to lower rates the next time, or are we going to keep them steady? What are we going to do in December?
Yeah.
Are we going to do it again? Are we not? And without the data, really, it was jobs over inflation. They were looking at the job report. That inflation was sort of where they wanted it to be, but now, which ironically, Friday we're going to get that report. We're going to get the
Right.
inflation report, but we're still not getting a jobs report unless something happens,
Right.
and quickly. So we're sort of going in without all the information.
And it's interesting because when you have a Fed meeting coming up, the jobs report's one of the things they really heavily consider, right? That's the dual mandate: keep inflation normal or keep inflation low and keep the jobs high. If you don't have the jobs report, how do you factor in 50% of that equation? So does it seem like the Fed's just going to make the decision blind? And because like everything I'm seeing is indicating there's going to be another cut.
Yeah. So first, I think the jobs, I mean, if we're just being honest, is probably more like 60%,
Yeah.
or more of the decision, because they're trying to see when that job market breaks, like that's a key definitely that they need to loosen the monetary policy, which is what it's all about. There's still other private companies that provide ADP, for example, provide some job numbers that give them a general idea. But the true, Bureau of Labor Statistics number, not so much.
Yeah.
And the longer this goes on, it's not just the jobs reports. It's not just what the Federal Reserve's going to do. Although I was reading earlier, there's like a 99% chance they're going to cut the rate another quarter, on the 29th when they come out and say what they're going to do.
Right.
And we've had all kinds of Fed president speeches. I mean, it's kind of like become a thing.
Yeah.
And so, and they're giving speeches at different events and, Chamber of Commerce luncheons and just whatever, across the country. And a lot of them are kind of saying the same thing. Like, well, yeah, I mean, we're going to cut next time. Not in those exact words.
Right.
But yeah, we're probably going to loosen a little, because, we think that that's appropriate.
Sure.
And then we're going to kind of maybe wait and see what happens, but probably going to
They
cut
love
again.
that word, that term, wait and see.
Yeah.
That's Jerome Powell's favorite thing
Wait
to
and
say.
see. But, I think as far as mortgage rates go, though, it's interesting. We're seeing, and usually before a cut,
Yeah.
we see a drop in rates. Rates went up, they got a little worse after the last meeting. They got a little better. We had a day Friday where nobody can really explain why they went down, but they did.
Yep.
Or Thursday, I'm sorry. And then Friday, they went back up a little bit. Today's a little better. I mean, if we talk in national averages, of what's actually being locked on mortgages right now, it's probably 6.25 for conventional, and FHA is probably in the high fives, 5.75, 5.625 maybe. Although sometimes we catch a good deal and it's lower than that.
Yeah, and that's a lot better than where we were just not that long ago. I think we were talking about getting somebody pre-approved back in, what was it, early 2025, maybe the springtime. And we were talking, 7 point something, almost
Right.
8, so rates are down, it doesn't feel like it to a lot of people, but they are. And, we're not seeing in my side of the industry as many people entering the market as we thought would when you can get a rate in the high fives. And I think a lot of it has to do with fear of the unknown, the government shutdown, what's going to happen with that, what's going to happen with, inflation and the jobs reports that we now can't get. So, I don't know are you seeing tick ups in loan applications? You seeing things kind of stay steady? Where are things at in the mortgage world?
So nationwide, I think mortgage apps are up again.
Yeah.
Last week they were down a little. Now they've been up a little bit. And I mean, we're seeing, and if you follow the path of a mortgage, how it typically goes, right? In our world, we measure credit pulls.
Okay.
So because that's what you're going to do. You get an application, you're going to pull credit, right? And then the next step, they go under contract and so on and so forth. So if you have a rise in credit pulls, you should see, 30 to 45 days later, you should see a rise in contracts, right?
Yeah.
And then closings, of course, after that. So it totally makes sense. And our credit pulls have been up, certainly. As a group, ours have been up. But I think what's happening, with our mortgage group is that we're actually gaining market share.
Yeah.
And so that makes it a little harder to tell, right?
Sure.
We're gaining market share and we're getting more applications. So
that's good. Yeah.
And we're getting it from different places too. The markets are changing as far as referral sources go.
Yeah, it really does seem like there's a lot of things shifting in the market right now, the way real estate is transacted and stuff like that. But, it's really interesting to me. I'll be interested to see if the government shutdown happens, or at the end to the shutdown rather, happens prior to the Fed meeting. How does that change things as far as predictable? I think everything is kind of set in stone for this particular meeting that we're going to see a cut.
Right.
But does that affect the December? Because there's one more, Fed meeting before the end of the year that's going to happen before Christmas. Do they do one final cut of 2025 then to make, what would that be? 3? Was it 3, or would that be 3 or 4 total cuts for the year?
3.
So,
yeah.
So just, boom, 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 right at the end of the year. And does that, really reinvigorate the real estate world after Christmas coming into 2026? So it's been a couple of rough years for people in our business. Mm-hmm. Thankfully, you and I, we've been able to manage because we have good pipelines and great clients that keep coming back to us. But for a newer person or somebody that's not, quite established, it can be tough. I hear a lot of agents that are talking to me saying, are people wanting to be agents? Should I get into this business in 2026? And I'm like, it seems like things are going to be going in the right direction. I don't know what do you feel about that?
I've been having that conversation with people for a long time. I mean, quarter of a century. And I remember, it was probably 15 years ago, a guy asked like, oh, what does it take to get in the mortgage business?
Yeah.
Well, so you get your license, make sure you got 6 to 12 months worth of savings in the bank.
Yeah.
Of your expenses. And then you start telling everybody that you're a mortgage loan officer for about 5 years.
Yeah.
And then you might be successful.
That's funny. Yeah.
He's like, well, that sounds really hard. I'm like, it is.
Yeah.
And the same thing on the real estate agent side.
Yeah.
I mean, sure, there's teams out there that'll give you leads and, but as far as making a living, there's going to be a trade-off.
Yeah. I mean, those leads come with higher splits. They come with referral fees to the lead sources. This nothing in life is free. And so it's really interesting to watch the industry kind of evolve into these, teams sort of getting these lead sources and divvying them out, and how that whole structure's worked, and which is, not necessarily the topic of this conversation, but I think seeing as things dried up a bit for the individual agent out there, it kind of did force a lot of people to teams. What I'll be interested to see is when things open back up and that, the referral engines are turning again, do a lot of people end up leaving teams and kind of doing their own thing and stuff like that? But, all in all, I'm pretty hopeful for 2026 as a whole in this market. I think if we have 2 more rate cuts this year, maybe a handful in the beginning of next year, you got to think that, while we're not going to be back to the immediate post-COVID days, we may be to a very palatable and tolerable, I should say, interest rate where people are jumping back in, or people who have been, kind of hermiting themselves in their house because they got a 2% rate, finally bite the bullet because the house just no longer meets their lifestyle needs. Yeah.
Next year, I do expect it to improve quite a bit. I mean, we've seen as a company, and personally, this year is better than last year.
Yeah, same.
Which is certainly great. And in reality, if we had COVID situation, there are not enough houses on the market.
Yeah.
And even the people that are sitting on that 2% rate, like still, a certain percentage of those have now reached a point where they're not going to sell it anyway,
Right.
or, maybe they're going to downsize, or, as far as the mortgage business goes, there's a little thing we noticed probably a year or two ago.
Yeah.
Everybody's value went up during COVID.
Yep.
So now, whereas people were putting, 5% down or whatever on average, now that's double. It's more like 10.
Yeah.
Might be 11 or 12. And, we got some people that are putting a couple $100,000 down in that house.
Right.
Which means as in the loan business, we get paid on a loan amount just like you do on purchase price.
Sure. Yeah.
So that makes a difference. But I think it's wise. The smart money right now is, and the agents and loan officers alike are positioning themselves to be ready. They're making their moves, switching teams, whatever, going off on their own, whatever they're going to do, make sure all their processes are set up so they're ready when the time comes.
Sure.
And some of them, are making a hard push. We're making a push for the end of the year, through some things that we're doing. We're seeing
By the
results.
way, you guys just closed your 300th loan. Congrats are in order. You guys have been operating since March, right? And
March 1st officially.
and there's 9 of you?
And there's 12 loan officers, 12 originators.
Yeah.
So
and you
I
made
believe
up
is the
for
number.
3 of those 300, right? So you're like, and the rest of the team did the other 297, or
Of course. Yeah, yeah. It's but if you don't know, we've never really talked about that Milo Mortgage is a group of folks who've been in the industry a long time, who know what they're doing and have been working together as a group for quite a long time now.
Yeah.
And under the leadership of our CEO, and when the last mortgage employment situation sold, then we decided, hey, it's time to go try this on our own.
Yeah.
And so, since March, in Friendswood, Texas, we've done 300 transactions, which is really actually pretty fantastic.
That's awesome, man. Yeah, if you 12 of you divided by 300 divided by 12, if you do that average, that's quite good.
Yeah, it's great. And, we have a lot of advantages for us, experience and, a lot of favor in the community. We have a good reputation, so all of that's helped. And at the end of the day, much like a real estate agent, if somebody's coming to get a loan or somebody's coming to buy their house or sell their house, they don't really care what name is on the door.
Right.
They're coming for you and your service.
Exactly right.
So, and it applies, just like it did 20 years ago. Same situation.
I think that's well said. And to round out the conversation, we talk about what we as agents and you as loan officers are doing to prepare for 2026. What should a buyer or seller who has kind of been waiting and seeing, to use Jerome Powell's favorite phrase,
right?
What should they do to prepare themselves if they're looking to dip their toe in the market next year?
I think it's wise to go look at your situation now.
Yeah.
Really, it's almost as far out as possible, because I even have people with like an 800 score, but they haven't really saved in a way, or their income is slightly off or something. They could eliminate a debt that, they could have eliminated 3 months ago. Now they're trying to buy.
Right.
And they need all their money for the down payment. So, it's like, well, you could have qualified for what you wanted if we had just had the time to look at your situation ahead of time.
Yeah.
So I think that's really the first thing. Look at your situation well in advance if you can.
Yeah.
Now, that doesn't mean wait to buy, because it's actually a pretty good time to buy right now. It's a buyer's market.
Yeah.
Rates are down. So, once everybody figures out that rates are down, that's going to change.
Yes, it is. Yeah.
You're not going to get the seller contributions, all the things we get, in a buyer's market. And certainly, if your credit is in bad situation, then you need to go talk to your loan officer, go figure out. They can do a soft credit pull that doesn't affect your credit.
Yeah.
And just take a look at the situation. And a lot of us have been doing it for a long time, and we can kind of look at your credit report and go, okay, start paying your bills on time.
Right.
No, it's not that simple. But we could look at some things and go, hey, if you did this, this, and this, you'd be in a better situation, to buy 2 months from now, 3 months
Right.
from now, or whatever it is. So, and I mean, what about on the real estate side?
I think the same thing. I mean, so if you're going to be a buyer, start saving for that down payment. Make sure you've got some closing costs tucked away just in case we do get into a heavy and hot situation where the sellers are not really apt to contribute to closing because there's more,
Yeah.
demand than supply, so to speak. So, at least tuck that away. I would say I always love when you give me a referral, right? And I mean, I love a referral of any kind, but when a lender gives me a referral, that means somebody has gone to a lender to talk about financing to see what the landscape looks like for them to potentially buy a house. Whereas, when people come to me, and this is what happens more times than not, right? In this sort of relationship, somebody comes to me to see a house because it's way more fun to go look at a house that you like than to talk to somebody about your finances. And then
Yeah.
I refer them to you. So I would say, you know, make the chain almost go in reverse from what you want to do. You want to see a house, you want to go talk to an agent, you want to go look at it. Sometimes it's better to have that conversation with the lender, go and look at what your landscape looks like, and then have that lender, make sure that lender is somebody who's worth their salt, and they're going to refer you to a good agent. So you're not just, landing on one of the many websites that you can get leads from, and you end up with an agent who you don't know who they are, who's paired to you to see a house. So you're talking about, go to a lender, get that referral from them, make sure it's a good quality lender, make sure they're referring you to a good quality agent, do your due diligence on the lender and the agent, and then, kind of make sure that your I's are dotted and your T's are crossed. And then you can actually start to shop with confidence rather than look at what his estimate says or what it says on HAR or realtor.com about what a house's monthly payment might estimate, or what the estimate might be, because as you and I both know, those are way off. So I think, if you're looking at dipping your toe into the industry in 2026, those are some things that you can do. Start having conversations with agents, start having conversations with lenders, start to save, start to put yourself in a good buying position. And yeah, maybe 2026 will be the year that you make home happen,
Make
as you
them
say.
happen.
Yeah.
Right. There you go. So it's a great place to wrap up.
Yeah, I think so.
So.